So we have a QBI question.
Uh-huh.
Someone wants to know, how do QBI qualified business income deductions work for an S corp?
Yeah, QBI was one of these things that was invented back in 2017 with the Tax Cut and Jobs Act. And this is the qualified business income deduction. What makes it qualified is that it's a trader business that's not a specified service. So, like tax professionals are a specified service and don't qualify for QBI. But basically, there's a short list of what are called SSTB, specified service trader business. If you're not on that list, then you're qualified. And if you have a business, the business income is going to be a pass through. So it's going to be a Schedule C, a Schedule F, a Schedule E, or it's going to be an 1120S, which is an S corp, or a 1065, which is a partnership. So it's one of those. Then it has pass through income, which comes home to the owners. So if you own 50% of an S corporation, the profit from that S corporation, 50% of it's going to go to you. And you have to include it with all your other income that year on your individual tax return. And the qualified business income deduction gives you up to a 20% break on that income, meaning that if you have $100,000 of pass-through income coming to you, then you might get $20,000 of deduction against that 100. So you're left with 80, and then you're taxed on the 80. So it can be, depending on the numbers involved, it can be a really powerful strategy. One, you have to have a qualified business. Two, that there are different thresholds depending on your filing status. Just off the top of my head, it's like 190, 380, something like that. It changes a little bit every year. But if you're single, head of household, married filing separate, you get the lower one. If you're married filing joint, you get the higher one. If you're under that threshold, then you get the 20% break. If you're on 100,000, 20% is 20,000, you get that deduction. If you're above that, though, then it becomes tested. So it becomes tested against 20% of the income or 50% of the wages paid by that entity or 2.5% of the assets owned by that entity. So if it's like a real estate company or a manufacturing company that's very asset heavy, most people end up with the 50% wage test. So they compare the assets to the wages, whichever one of those is higher is then compared against the 20% of the income, and whichever one of those is lower is what you get. There's some additional modifications there with itemized deductions and capital gains, but that's the basics. Um, so it is a very complicated deduction. It takes a lot of planning to make sure that you maximize that as well as possible. And it's going to depend on your business structure. But yeah, it's like 4 years to really build a worksheet that really worked as far as the planning side for qualified business income deductions in order to make sure that's as efficient as possible. Um, but yeah, it's super powerful. 20% may not sound like a lot, but especially if you're in higher brackets, it's enormous.
You say that too.
Yeah. So if you're in a 37% bracket, then 37% of 20% is 6 or 7% like net cash in your pocket. That's a lot.
Just got to
So
do it right.
just got to do it right. It takes a lot of work, to be honest. And you get to continually update it throughout the year to make sure that you're on track for maximizing that.
Understood.